Getting these 3 items in order will get you ready for success when it comes to home ownership. Number 1 is income. Number 2 is your credit score. And number 3 is your saving. I'll go into detail. Number 1, when it comes to income, financing companies look at steady income for the last 2 years. Means if you're unemployed, you need to be working in the same profession for the last 2 years. The only exception is if you just graduated from college and found a job, that could be an exception. Other than that, financing companies, when it comes to mortgage qualification, require 2 years employment in the same profession. If you're self-employed, make sure you have 2-year tax return in that same business. If you have an accounting firm, make sure you have a tax return for 2 years in accounting firm. If you have a childcare, similar. If you have a dentist office, similarly, you need a 2-year tax return. On this particular point, when you are self-employed, we look at your net profit after expenses. Means if your company made $300,000 gross, we look at the net income after expenses. Maybe you have transportation expenses, this kind of expense. What you put as a net profit is your qualifying income when it comes to mortgage. The only thing that we add back is depreciation, or you have a business mileage or business use of home. If you use your home for business, this can be added back, obviously based on your kind of business you are in, based on the different scenarios. Number 2 is your credit score. Your credit score plays a big role when it comes to home financing. You want to make sure your credit score is above the minimum, which is 620 or above, obviously. However, when you buy a home, you want to have the best credit score as possible, as it impacts your monthly payment, as it impacts your down payment amount. It plays a big role. So ideally, it's good to have a credit score above 700 if possible, but the minimum to qualify is 620. Last but not least is your saving. It is very important to have a steady saving when it comes to home ownership, as the minimum requirement for down payments is 3%. However, it's recommended to put out as much as possible, especially 20% down, to avoid paying PMI. The higher the down payment, the better term you get. However, don't worry, with our program, you can put as low as 3% down. Means if the house is $400,000, all you have to put is $12,000 out of pocket. Other thing when it comes to saving is also saving for closing costs. Closing costs are usually estimated around 2% of the purchase price. Means if the house is $400,000, you should expect $8,000 for your closing costs, like your taxes, home insurance policy, escrow fee, title fees. It's like when you buy a car, there are fees. When you also buy a home, there are a few costs here and there. Be prepared at least for 3% for down payment and 2% for closing costs, at least 5% down. I hope that was helpful. Follow this page. Thank you so much.